Welcome everyone to the Kindle Report, where I share my 40 years of experience to help you manage your portfolios and protect your wealth. Remember to subscribe, like, and share these videos. As we look back on yesterday, we saw yet another algorithm-driven rally. What was it this time? The same thing that we've seen day after day, which is about the stimulus deal. Supposedly there was a 48-hour deadline. It was just a deadline so they would have all their negotiating points together. Of course, that's not how it was promoted on Saturday. It was some kind of line in the sand that we had to have something done. So market algorithms bought into this. We saw the S&P up 1.5%, only to fade into the close up about 0.5% at the end of the session. The NASDAQ also faded. We were up 0.3, as was the Russell. The reality is, it's unbelievable to me that the markets continue to be driven on this very weak narrative. I realize that you folks got to be sick and tired of hearing this, but there's not going to be a deal. They don't want to make a deal. They're not trying to make a deal. And let's face it, the two sides can't agree on anything. But the point is this, is that the algorithms and the market participants continue to buy into this narrative. All it does for those of us that are trading on a short-term basis give us opportunities to fade these rallies. We saw that happen today as we traded right into the R3 RXT number on the S&P, and we saw a reversal down. This is going to continue to happen as long as this news is out there. Tonight, we're also seeing a bid back in the market. S&P's up roughly 14, 16 handles right now. Why? Because there's still a deal coming on. Meanwhile, we've got real things going on, like earnings and other things like that, are continuing to show a mixed result. Netflix came out and missed substantially after the close. But the realities of what we're dealing with is it is a news-driven cycle, and we're not going to get out of this thing for a number of weeks. As we look forward, think about what we have to look forward to. We have the continuation of the stimulus talks. We've got the presidential debate on Thursday, but we have elections. We have an antitrust suit going on with Google. It's just going to get more intense. So volatility is likely to kick up again, and we'll start to see this market churn. But we're also starting to see some of the metrics in the market starting to fade just a little bit. Every time we get this rally and then a failure, these markets are starting to get closer to rolling over. I still believe we're in this very broad correctional phase, which is likely to continue at least into the election and beyond. I've talked about this in some of my longer term statements, primarily on my live streams, is that I believe that we could see this churning go all the way into year end. It's going to be a very interesting next 2 to 4 weeks, as there's just so much that the markets are going to have to deal with, and the machines are going to drive the volatility. We're going to see both sides of the markets, in my opinion, as we go forward here. Now, we are contracting into a narrower range as far as we go forward, which is somewhat worrisome. We will usually decline out of these types of configurations. There's no material news that is coming out today. Market participants will start to think about the employment claims and the continuing claims on Thursday. That's going to be the fundamental narrative. As far as Wednesday goes, it appears it could be a pivotal day. We saw an inside trading day on Tuesday. We're likely to see an outside reversal today, as I'm looking for volatility to kick up a notch. The last thing that I want to mention before we go into the technical section is we are seeing interest rates start to pick up, and the yield curve is also steepening, which I've been discussing over the past several months is a key element of the Fed strategy. So let's go ahead and take a look at the charts, see what they're telling us for Wednesday. As we take a look at the WaveTech database, very little changed overnight. We basically have a churning going on. We had 225 new buy signals. We had 230 sell signals, as the database just churns at this 34.27 level. I continue to watch for a trigger in this database above 42%. I do not expect that's going to happen. We'll continue to suggest that we will be in a sideways range as long as it remains under that 42% level. Tonight we're going to take a brief look at the 10-year treasuries as they are trading right into resistance. This is going to be a key area, 8.13. We finished yesterday at 7.97. The high was 7.99. We're likely to continue to spike above this level. There will be substantial resistance. If we do get above that, then the next level will be the 836 level, will be key on the 10-year Treasury. But taking a look at the 1030 spreads, and I've discussed this in detail over the past several months, but this is exactly what the Fed wants to see here. They want to see the 1030 yield curve steepening. They are manipulating the back end of this curve, so they continue to want that back end of the yield curve to float higher. They want to see the 10-year move up to at least that 850 plus level. Potentially, they want it to go up to 1%. This is definitely a strategy by the Fed to keep this yield curve steepening, and ultimately this spread itself will help the financial sector, which is one of the largest sectors in the market. So this could fuel a rally in this next cycle once we complete this sideways pattern. Reviewing the S&P 500 futures, we continue to see this overnight bid. We're up 16 handles right now, 34.48 on the futures. As we look at the grid, we'll see that R1 is 34.46, R2 34.63. That is likely to be the higher end of the range today at the 63 level. Also, the 10 moving average is at 34.67, and we're starting to see PPM1 cut through its first and second derivative, and this is suggesting that we're going to stay below that 10 period moving average. And now we're going to be sandwiched between that 33.98, which is the 40 period moving average on a daily, and that 34.67 level. So expect to see the market work within the grid. The key level on the downside today, 34.17. That would be a new low off of yesterday's low. This is highly likely that we'll at least see S1 R2 today, but there is a possibility if we trade through 34.17 to go down to that 3400 level. As I mentioned in yesterday's video, 3400 right now is the bottom end of the range. So let's continue to discuss this pattern that I've been talking about for the past several months. This is the ABC pattern. So this is 3 waves down, this is an A wave, 3 waves up, this is a B wave up here. Now we're working on the A. There should be a B wave and then another C wave down, which should come down into this bottom end of the range. I've talked about this before, around 3,200. There's some other numbers that we can look at on the weekly chart that gives us a little better view, but this is the basic pattern that continues to unfold. If we were to take out the highs that we rendered 7 sessions ago, then it's likely we could go up and challenge that 35.80 all-time high, but it doesn't look like it's going to be possible, and the momentum losses that we're seeing. As we review the weekly cash chart, the 10-week moving average is sitting here right at 34.04. This is going to represent major support right now. The PPM is at 0.21, so we are seeing it fade substantially. PPM2 is at 0.58, but it's trying to break through. It's trying to break through its second derivative, which would be a negative sign if that happens. So far, we're holding that level, but the key level will be that 3400 level. Below that level would be down toward the 3360 with an extreme of 3292 in this pattern. The next market I'll cover is the NASDAQ futures. We're seeing up about 0.5%, up 64 handles right now. The market grid for today, R2 is 11,791. We're trading just above R1, which is 11,722. The high so far in tonight's session has been 11,739. We're moving back toward the key moving average in the pattern, which is the 10-day at 11,814. That would represent a near perfect hit, just a slight extension above the R2 number. And then we're likely to remain, just like in the S&P, between the 40 period moving average and the 10 moving average. Also, the 21-day moving average is at 531. The 40-period moving average is 11,523, basically the same, and S2 is down there at 11,530. So this is likely to stay within this pattern. We're also looking at the Fibonacci grid that I have over here. 11,773 is 0.618. So we exceeded that. We went above the 0.76 number. We're coming back into that Fibonacci range. And also 11,560 is down at that 50% range. So that Fibonacci grid still has a lot to do with the pattern that's unfolding. But just like in the S&P, today's action will be key to figuring out the next several days. The 10-day moving average will be the key level to watch. That's 11,815 with R2 11,791. So look for us to potentially trade into that range, maybe see another reversal. PPMs are all fading here on the daily NASDAQ as well. In yesterday's video in the review of the US dollar, it looked like it was going to hold support. Even though we're seeing the market move down toward the lower end of the grid, which we're down at 92.95, we're not seeing a lot of acceleration on the downside. This should be very close to the bottom of this pattern. S2 is 92.85. I think that will be the extreme if we print there. R1 93.21. We've been at 93.07, so we're likely to see it stay within this range, at least for today's session. The final market that I'll cover tonight is gold. Gold continues to trade within a very tight range, the upper end being 1925, which is the 40-day moving average. So far, the high's been 1924.50. Last trade 22. We're trading near that upper end of the band. If we look at the market grid here, we'll see that R2 is 1925.70, R3 1931.20. I still expect to see this thing stay in the range. The one thing that is beginning to happen on gold, that we're seeing a penetration to the upside on PPM1, both first and second derivative. PPM2 is also doing that. We're not in trend mode, but we're starting to see the type of elements that suggest that this market wants to move higher, potentially into the 1935 to 1942 level. This becomes a bit more visible on the weekly charts. Now, one of the things that I've been discussing over the past several weeks is that this sharp downsloping PPM1, it was down almost 0.40. That is completely dissipated now, 0.14, which suggests that there is now a 50-50 chance that we will get above that 1929.50 level. If we get above that level on a Friday's close, that will signify a move back into the Fibonacci ranges, back toward 1941, and potentially going as high as the 1969 level, which also is up at the upper end of the weekly grid. R2 is 1937, and then R3 1954, RXT is 1968. That will represent a move up to the extremes in the grid. Further evidence that we're trying to turn this market back higher is the configuration both on the PPM2 and PPM3, which are starting to turn up. We have not got signals there yet, but the configuration is close to signaling a weekly move, and that will easily take us up toward that 1969 level, potentially going back to test the 2000 level. So I'm starting to get a little bullish here on gold. We're going to watch the next couple sessions, should tell us whether there's going to be a breakout. If you're a WaveTech user, you'll know that GLD went long last week, so we've already holding some of those gold positions on a daily basis. Going back to the daily chart for a minute, there was a buy signal which coincided with that GLD buy at the 1935 level. So we did get a buy signal. The logic is still holding that, suggesting that we're going to go up into these ranges that I've talked about. So look for a move toward that 1939, 1942 level, and the possibilities of signaling a breakout for gold here. This will complete the video for tonight. Don't forget, we have our live stream tomorrow, 1:30 New York time on Wednesday. Thanks for watching.